What's up guys, coming at you from my bedroom. Sorry. Today we've got a video on transfer pricing, which is surprisingly interesting. So let's get into it. Awesome. So transfer pricing usually falls under management accounting, and we know that as being Division A sells goods and services to Division B, and they all form under the same entity. But actually, transfer pricing is mentioned in tax. We have different tax implications for when companies transfer goods and services within the company. Oftentimes there'll be no tax effects. And then in group accounting setting, obviously we have intercompany transactions, and that could be seen as transfer pricing. So I think in a test setting, it's very good to get to grips with the subject because they can integrate this question really nicely. And then in a real world setting, people often use transfer pricing in companies to avoid tax, because if you're transferring assets between one company to another, you can use tax rules in order to mitigate your tax. Oftentimes SARS will have an issue with this. In fact, it's one of the areas that they feel that they've lost out on most of the fiscus. So very relevant, very cool. Yeah, so I briefly touched on it, but I will get into more depth about it now, and that is, what is transfer pricing? So in a management accounting setting, transfer pricing occurs between different divisions of the same company, where Division A, who is the supplying division, transfers goods and services to Division B, the receiving division, and it's saying, well, how much should that good or service be priced at between the divisions? So Division A will make an intermediary product to sell to Division B, who builds on that intermediary product to sell to Division C, who then goes on to sell it externally. And all transfer pricing is asking is, how much should these intermediary products be priced at within the divisions? Now, for a real world example, let's say we have a holding company called Meta. And Meta, as we know, has subsidiaries Facebook and Instagram. And in this case, because management accounting generally deals with divisions within a company, I'm not going to say that this is a parent-subsidiary relationship. I'd rather say that Meta is the company and Instagram and Facebook are different divisions. Let's say that Instagram needs to make the certain good for Facebook, who will then go on to sell a finished good to an external market. So in this case, Instagram will be the supplying division and Facebook being the receiving division. Now the question becomes, how much is Instagram willing to charge Facebook for this product, and how much is Facebook willing to pay for this product? From Meta's point of view, it doesn't really matter, because Instagram is receiving the same amount of revenue as Facebook is paying to Instagram. So the costs and the revenue cancel out. However, the individual divisions' profit margin, so Instagram and Facebook's respectively, will be affected, and this will incentivize them accordingly. But what does matter to Meta is that they achieve, firstly, the goals of transfer pricing when pricing this product, and also that they're making a profit at the end of the day. So the goals of transfer pricing are, firstly, we want to achieve goal congruence. And goal congruence means that Meta's goals of achieving a profit and Instagram and Facebook's goals are completely aligned. That Instagram and Facebook are acting in the best interest of this company, Meta. And how this is affected by transfer pricing is that the certain transfer price will incentivize each division to act accordingly. So if Instagram won't earn a profit from transferring to Facebook, but could potentially sell externally and earn a profit there, they may be incentivized rather to sell externally than to transfer to Facebook. And this isn't achieving goal congruence, because this isn't in Meta's best interest. The next goal is performance evaluation. And what this is saying is that, does the transfer price allow these different divisions to be evaluated fairly? If we said that Instagram is evaluated based on profit, meaning that if they don't make a profit because they sold to Facebook, because their price was set really low, and now they're not going to receive a bonus because they made a loss, then they're not being evaluated fairly. So the transfer price must be set in order to compensate for that loss. And lastly, we want to preserve autonomy. And that's basically saying that these divisions shouldn't be the puppets of Meta, that they should feel like at least they have some say in operating decisions or in things such as setting the transfer price or the performance evaluations. But ultimately, when we think about transfer pricing and how we set the price, we must always keep in mind that Meta, or the company, the main company, needs to achieve a profit. That's what they're after. And with these goals in mind, we need to think of a suitable transfer price that we can achieve goal congruence, performance evaluation, preserve the autonomy, and mainly make a profit. And so that's where we're going to start from. In transfer pricing, we know that Instagram would have a minimum price that they're willing to sell for, while Facebook has a maximum price that they're willing to pay. So your transfer price is going to lie between two ranges usually. So let's look at the minimum price. Generally speaking, Instagram has three options. They can produce and transfer to Facebook, they can produce and transfer externally, sell to an external market, or they can just not produce it all. And this will depend on how they're incentivized. So now looking at the minimum price in depth, just to note, in the decision of making taking our minimum price and our maximum price, we are looking at short-term implications. Therefore, for the most part, we are ignoring fixed costs. So let's look at 3 scenarios for this minimum price. In the first case, let's say there is no external demand for Instagram's product, i.e. from a group level, they are not earning any revenue. So what's happening here is that Instagram is incurring these variable costs to create a product, but they're not going to incur any revenue. Sure, they may sell to Facebook, but we know from a group level that revenue doesn't count as actual revenue because it cancels each other out because it's within a division. Therefore, our transfer price is to be set at a level that covers these variable costs. Therefore, the minimum transfer price that Instagram is willing to accept is equal to the variable costs incurred to create the product. So anything less than the variable costs incurred, they would be incurring a loss, and that's not fair for Instagram. So they would be indifferent at the point where the transfer price or the selling price to Facebook is equal to the variable costs, because at this point there's no profit, there's no loss. Awesome. In this next scenario, let's say that we have external demand, so people do want Instagram's product externally, not just within the group, but that we only have sufficient capacity to fulfill this external demand. In other words, saying that if we transferred even one more unit to Facebook, we would lose out on an external sale. Therefore, the group is losing out on the revenue from the sale as well as gaining back the variable costs on the sale. Obviously, therefore, the opportunity cost there is the contribution margin of the external sale. And maybe that sounds a bit confusing, so let's give you an example. If Instagram has a capacity of 10,000 units and our external demand is also 10,000 units, and that's saying even if Facebook asks for 1 unit from Instagram, that means that they could only supply 9,999 units to an external demand. That means they're losing out on 1 sale, and that 1 sale represents the contribution margin because we lose out on the revenue but we gain the variable cost of the sale. Therefore, in this scenario, our transfer price will have to cover the opportunity cost of the sale as well as the variable cost to transfer to Facebook. Our transfer price is going to be our variable cost per unit plus the opportunity cost of the external demand, and that is equal to the contribution margin per unit of an external sale. Where it becomes a bit trickier is where we still have an external demand and we still have a capacity constraint, but we can supply some units to Facebook without giving up any external units. So let's say Instagram has a maximum capacity of 40,000 units. There's an external demand for 10,000 units and Facebook requires 35,000 units. So we can see here that our total demand is 45,000 units. That's the external demand plus Facebook demand. Therefore, we're 5,000 units short of our capacity. But we can still supply Facebook with some units before we meet our capacity constraint. So up to that point, there is no opportunity cost. However, thereafter, we will have to start giving up external units. Therefore, there will be an opportunity cost, and that will be equal to the contribution margin of external sales, just as before. So in this case, we're actually going to have a range of minimum transfer prices. I'm going to do a nice graph just so it makes it a little bit less complicated. So our capacity is 40,000 units, our external demand is 10,000 units, and Facebook's demand is 35,000 units. So we can see for the first 30,000 units, we don't have any opportunity cost because we can supply 30,000 units to Facebook easily and still satisfy the 10,000 unit demand externally. Therefore, our transfer price is just going to be our variable cost to cover the cost of producing this good. We're not incurring any opportunity cost at this point. However, if we sell any one unit over 30,000 units, we know that we can't satisfy the full external demand. Therefore, we are giving up on an external sale and losing that contribution margin. So for the range of 30,000 to 40,000, our transfer price is going to be our variable cost plus our opportunity cost. So let's just do a quick summary of a minimum price. When we have no external demand, our transfer price is equal to our variable cost to cover the cost of production. When our external demand equals our capacity, our transfer price is equal to our variable cost plus our opportunity cost for the full range. And then when we have a capacity constraint, but we can still supply some units to our division without giving up external demand, then we have a range of minimum transfer prices as follows. So your transfer price is going to be the variable cost plus the opportunity cost for the full external demand, and the remainder is just going to be the variable cost. Now the next question we ask, okay, cool, well, Instagram's happy to sell at this price, but is Facebook willing to accept that price? And here we're looking at our maximum transfer price. Now what's happening is that Instagram is selling to Facebook, who is then building this product and selling it off to an external market. So therefore, from a group point of view, they are earning revenue. But Facebook isn't going to buy from Instagram if they're going to incur a loss on the sale. I.e., they're just a normal company. They want to be making a profit. So Facebook might incur other variable costs costs to get this product to condition to sell, and they want to cover basically the selling price of this product less the other costs involved before they buy from Instagram. So let's call the costs incurred to Instagram the transfer price. If this equals a negative figure, they're not going to buy from Instagram. Therefore, the transfer price has got to cover the selling price less their other variable costs before considering the transfer price to Instagram. And this is known as our net marginal revenue. So naturally, if they set their transfer price at the net marginal revenue, they would incur zero profit, zero loss, and therefore would be indifferent at this point. We must also be mindful of the fact that Facebook could buy the exact same software as they could from Instagram, but for much cheaper, therefore earning a greater profit. And from a group perspective, this isn't really aligned with goal congruence. We'd rather keep it in the company. Therefore, the transfer price must also account for this. So therefore, our transfer price is set at the lower of either the market price, so what Facebook could purchase this good from an external market, or the net marginal revenue, i.e. it needs to cover their short-term profit. And it's not always the case that we have a market price or an external person that we could buy this good from. It's very scenario specific. Just be on the lookout for that. In summary, our maximum price is going to be the lower of our net marginal revenue, which is our selling price less other variable costs, so not our transfer price, or our market price, and that's what Facebook could buy from an external market. And now for the final question, we have the minimum, we have the maximum, now what? What's our actual transfer price? And now, as mentioned before, Meta has the goals of wanting to achieve a profit and also to achieve the goals of transfer pricing, so goal congruence, autonomy, and performance evaluation. So we need to set a transfer price that achieves all of those goals. And so the first goal of profit maximization is saying that Meta wants to maximize their profits. They want to sell a certain amount of each product so that they've achieved the most amount of profit possible. And we've seen this before in relevant costing. Whenever we have a constraint and we have to maybe give up a product because we can't sell all of them, we're giving up the product that gives us the least amount of contribution margin. We want to sell the product that is most profitable. So if we need to decide between are we producing product A or product B because we can't produce both, which one do we give up? We know we're looking at contribution margin per limiting factor. So if Instagram produces a product A and Facebook produces a product B, we want to know which one is the most profitable in case there's a constraint issue and we can't produce both. We'd have to give up the least profitable one, so the one with the lowest contribution margin. And keeping in mind, this contribution margin is calculated from an external point of view, so it doesn't include any internal transfers. So let's say that the contribution margin of Instagram's external sale is 100 Rand and Facebook's external sales is 200 Rand. We know then that we'd want to satisfy firstly Facebook's demand because they produce the most profitable product. Then we're going to satisfy Instagram's external demand because that's the least profitable, i.e. we've ranked them in terms of their profitability, Facebook being 1, Instagram being 2. The problem here is that Meta is obviously gunning for Facebook to make the most sales and for the demand to go to Facebook because they are earning the highest group profit. But if Instagram's contribution margin for external sales is higher than the transfer price to Facebook, i.e. they'd earn more of a profit if they sold externally, then obviously they're going to be incentivized to sell externally rather than to transfer it to Facebook. So there we don't have goal congruence. And where the goals of transfer pricing come in is in performance evaluation. If Instagram is being evaluated on their profits and they're earning less profit because they transferred to Facebook, they're not going to be evaluated fairly, and this is not going to incentivize them to transfer to Facebook. And if Instagram is being incentivized to rather transfer their product A externally, not to Facebook, then the group isn't going to be happy because they're not going to be able to satisfy their demand, which is the most profitable. So you see, we got an issue. And so in order to solve this issue, what we're going to do is calculate the profits, the actual profits per division. So for Instagram, for Facebook, taking into account their fixed costs, and ideally the transfer price will be set at a price such that they're able to cover all their costs, variable and fixed, so that both divisions are happy. So you take into account the minimums you calculated, the maximums you calculated, plug this into their profits and see, do these ultimate profits end up being positive, do they end up negative, which profit is larger on both sides, are both divisions going to be happy with this outcome, this price? Because what could happen is that you plug in the minimum price that you calculated and perhaps it yields the fact that Instagram is making a whopping loss and Facebook is earning a huge profit. Therefore, you know Instagram, if they're being evaluated on their profit, they're not going to be happy. So maybe you'd set that price a little bit higher, but still within Facebook's maximum, so they're still happy to pay that amount. So in summary, when calculating this final price, we've calculated our minimum prices, we've calculated our max price. Then what we do is we calculate the total profit of each division of Instagram or Facebook, looking at our optimal mix, because obviously the group wants to sell what is optimal so that they make the most amount a profit. And then we plug in these separate mins and maxes. And ultimately we get this final profit figures for each minimum, for each maximum we plugged in. And we say, does this achieve performance evaluation? Is it fair? Because if Instagram or Facebook is earning this huge loss and the other division is earning a huge profit, obviously that division is going to be remunerated accordingly. That's not really that fair. So you wouldn't choose that transfer price. Does it achieve goal congruence? Is it forcing one of the divisions to rather sell externally than within our group? That's not achieving goal congruence. So therefore you would choose a price that incentivizes the one division to transfer internally rather than externally. And so the final transfer price should achieve the goal of Meta wanting to achieve the best amount of profit that they possibly can, whilst also making the divisions happy, so that they're fairly evaluated, they have autonomy, and there's goal congruence between Meta, Facebook, and Instagram. And the last issue you may encounter with transfer pricing is what happens if your minimum price that Instagram is willing to accept is greater than the maximum price that Facebook is willing to pay. So for example, if the minimum price that Instagram is willing to sell for is 300 Rand, but Facebook will only buy it for 200 Rand, we obviously have an issue here. There's an overlap. And in this case, we have two short-term strategies, that is dual transfer pricing as well as lump sum. So a dual transfer price is more of an accounting entry than anything else, and that's where Meta will buy from Instagram at the 300 Rand and then sell to Facebook at the 200 Rand. So everyone's happy, the profit will lie within Meta, but that will ultimately be cancelled out upon selling it off. So it's all good. So in this case, Meta will act as an intermediary between Instagram and Facebook rather than Instagram transferring directly to Facebook. However, we generally prefer to do a lump sum. And how a lump sum works is like this. Let's say we worked out two minimum prices for Instagram. Let's say for the first 30,000 units, their minimum price is 100 Rand, and for the next 10,000 units, it's 150 Rand. But Facebook's maximum price that we calculated is 125 Rand. So we can see what happens here is that Facebook is happy to purchase this first 30,000 units at 100 Rand because that's less than their maximum price. However, for the next 10,000 units, it's 25 Rand over what they were actually willing to pay, and so they're not going to do that. So what the lump sum says is that, okay, well then we agree that for the first 30,000 units, you can pay the 100 Rand, and for the next 10,000 units, you can pay the 150 Rand, giving you a total lump sum of 4.5 million Rand for the full 40,000 units. And that's effectively saying that it's 112 Rand 50 per unit. Therefore, always less than our max, so therefore everyone's happy. But in a lump sum, it is important to note that you're not paying 112 Rand 50 per unit, you're paying the lump sum amount. That makes sense? And that's all from me on transfer pricing. I hope that made some sense. It is a bit complex, I must be honest. It's like one of those where you're like, this is so different from what I remember. But it's one of those that you really have to logic out and think in the company's boots. You know, what you want is a profit, ultimately. So you're working out your product mix and you want to achieve the goals of transfer pricing. Once you've got that in mind, you should be A-okay. Cool guys, thanks for watching and I'll see you next time.